Hey guys, Andre Garcia here, Lightning Loans by Innovative Mortgage. And I wanted to make a quick video because of what's happened with the collapse of Silicon Valley Bank. There's been a couple of other banks, but the other two banks had ties to cryptocurrency. I don't take cryptocurrency seriously, and I don't suggest that you do either. We'll leave it at that. But this conversation is going to be focused around Silicon Valley Bank. I'm going to do my best to explain it without dumbing it down. You know, I want you to understand but I don't want to dumb it down either. I want to provide you complete information. So, unlike some of the things that you might have heard when the news first started going around, I was led to believe that Silicon Valley Bank was a startup. They're not a startup. They've been around since 1982, but they have changed. They have changed their offerings over the last several years, they've significantly changed their offerings in order to attract new business, and it has worked really, really well. They saw really unparalleled growth. One of the ways that you can sort of see how healthy a bank is based on the amount of deposits, the amount of new customers, the amount of deposits. And as you can see, the stock has been very, very healthy. You know, I mean, it's up here at $400, at the $300 that it was trading. It was low, because you see just a few months before, and we're looking $760 November of 2021. November 8th of 2021, this stock was trading for $761, almost $800. Okay? So since November, what is that, 5 months? In the last 5 months, they went from trading at $761 to within a 44-hour period. This is a week, this is the weekly chart, but most of this downturn happened in a 44-hour period, and now they're bankrupt, so they're worth zero. So it went from $761 5 months ago to zero, and essentially happened in 44 hours. So that led them to file this with the SEC. You can see the California Department of Financial Protection and Innovation and the FDIC. The bank was shut down by the California regulators and handed over to the FDIC. So they're bankrupt. No other way to put it. As this is their website now, just redirecting the few clients that they do have, but the bulk of their clients waiting on the government. Now, you hear a lot of reasons, and that's one reason I wanted to dig deep into this, because I wasn't getting a very clear picture of exactly what happened or how it happened, but I knew that there was going to be a lot of paranoia about, a comparison between this and what happened in 2008. It's the fundamentals are completely different. The fundamentals are completely different between what happened in 2008 and what happened now. And if you stick to the end of this video, you'll see some of the major differences. Okay, we'll just leave it at that. So this is an investor that specializes in fintech. Fintech is essentially a new word that they made up for the companies that work with the modern technology, the modern programming technology, and banking, essentially. So that's fintech. Modern banking is fintech. So the mobile apps and these people that these crazy loans that you can get for like I don't know, whatever. Modern banking, that's fintech. So this guy who's an investor who specializes in fintech investing, he's mad because he's blaming it on the venture capitalist, and the reason that he's blaming it on venture capitalists, because it was, to be fair, it was the venture capitalists that sort of started calling the companies that they invest in and telling them, hey, you got to move your money. Hey, you got to move your money. You got to take your money out as soon as possible. So what I want to do is explore a little bit about how and why that happened. Okay, so first, a 200-foot, 10-second overview of how banks make money. Step one, you go open up a bank account, you deposit money. That money is still your money, but is being held by the bank. The bank, the way that the bank makes money is they put that money to use. They make loans, so they do your mortgage, they give you a credit card, they give you a personal loan, they give you a car loan. That's one way that they make money. The other way that they make money, because they can only make so many of those loans, the other way that they make money is by investing in what is usually low volatility and generally safe investments. Okay, now there's always risk when you're trading, but essentially they're glorified stock. They don't put it into the stock market. I don't want you to think that, but stocks, bonds, options, futures, it's all essentially very similar. The price goes up, the price goes down. Nobody really knows what's going to happen. It's always 50-50. Sometimes it goes up, sometimes it goes down. Some people are better at guessing than others, and that's the long and the short of it. Okay, so you put your deposit in. They turn around, they lend money. When they lend as much money as they can, and number one, number two, they lend as much money as they can, and then if they still have a lot of money left over, they turn around and they put that money to work in other ways. Okay, now the way that SVB and many other banking institutions, it's not just SVB, but one of the ways that they invested that excess money, and just to show you that some of the excess money here, we take a look here. So you see in fourth quarter of 2022, and I'm not sure if this is for the full year. Yeah, this is full year. Full year in 2022. In 2022, they received $185 billion in deposits. They made $70 billion in loans. Okay, the rest of that money. So you see that there's a big shortfall. There's $115 billion, and they have to figure out. I mean, I don't think you can quantify in your mind how much money that is. Imagine having to invest that in someplace safe, where it's going to stay the same amount or grow. Hopefully, really, what they need to do is grow. So the highest chance to make money without losing money. One way that happens is they invest in long-term debt. Okay, long-term debt. So essentially, mortgages. Mortgages are packaged. They're turned into a product. So imagine a single mortgage is a brick. They take all those bricks and they make a house made of mortgages, and you can buy that house, or you can buy shares, you can buy pieces of that house. Think of it more like a timeshare, I guess. So see, all this money, this $115 billion shortfall, they took a lot of that money and they invested it into long-term debt at 2%. 2%. Now remember, the way that they make money is by the way that they make money is by putting that money to work. So interest rates are low, they're only making 2%. If interest rates are higher, they make more money. Okay? So, and remember that this is like a house. Now imagine your house, 2%, people move in, they start making 2%, right? And they give you some money and they start making 2%. And right across the street, a house opens up and they're paying people to live there, and they're paying them 6%. Now, how much do you want to make? Do you want to make 2% or do you want to make 6%? You want to make 6% if you're the one that's making money off of it. You want to pay 2%, you want to make 6%, right? Okay, so the reason that matters is because the value of the bond, the underlying value. Now, if they hold on to the money, if they hold on to that bond, they're going to collect their 2% a year off of $117 billion. That's $2 billion a year. just for having the money invested in these long-term securities. Okay, and remember that what they're doing, this money, where it came from, is customer deposits. So they can keep that bond, and they'll make their 2% a year. They were in a pinch. They had a lot more money than they were anticipating. Maybe they weren't prepared to have that much money. They weren't able to diversify it. They just needed to do something with it, put it to work. So they say, forget it. We're growing at a rapid pace. Let's take this $100 billion. We'll put it into long-term debt. We'll collect our $2 billion a year. And hey, it's not all the money in the world, but $2 billion is a decent enough profit for us. Bam. So what happens? Now, as I mentioned earlier, there's a house across the street, 6%. They're paying 6%. They're paying people 6% to live in that house, right? What's going to happen to the value of your 2% house? You have direct competition. They're paying triple. The underlying value has gone down, but it's sort of like you living in a condo, and let's say the value of every condo, it goes up, it goes down, it goes up, it goes down. It's just value. It's just equity. Unless you sell the property, or unless you refinance, of course. But let's just talk about, if you don't sell the property, you don't make or lose money. It just stays being your house. So that 2% debt, it would have been low risk. It would have paid them $2 billion a year, and then as time goes on and their business continued to grow, they would have gotten more and more of the 6% debt in order to make more money. But they had to sell the 2% debt. And hopefully you kind of sort of got that. By selling the 2% debt, they make it so if you bought your condo for $100,000, let's say you bought your condo in 2007, right? 2007, and then if you were, prices in 2008, 9, 10, they were down, right? But if you didn't sell, you would actually be up. If you bought for $100,000 in 2007 and the price goes down $50,000 in 2008, you don't lose that money until you actually sell that condo and give it to somebody else. All right, you paid $100 cash, you get $50 back. You lost $50,000. Now, if you didn't sell and you kept it until now, that same that condo that you bought for $100,000 in 2007 might be worth $200,000 now. So the point of that little spiel is that it wouldn't have mattered about them being down, about the value of the bond being down, because they're still collecting the 2% debt. But that's where the run on the bank comes in. Because as more and more people were requesting their funds back, as more and more people were requesting their funds back, like, I want my money out right now. I want my money out. I want to move it here. I want to move it there. People were taking liquidity out of the bank. In order for them to be able to keep up with the demand of customer requests to withdraw money, they were forced to sell that low interest rate debt in a high interest rate environment. That is what caused them to lose all that money. So they lost money because they sold their long-term debt in order to keep up with customer deposits. They were forced to keep up with customer They were forced to keep up with customer withdrawal requests, and because of all those withdrawals, they were forced to sell the debt. And it's kind of like, if you had that condo that you bought for $100,000 in 2008, somebody puts a gun to your head and says, "Give me $50,000 or I'm going to shoot you in the head," and you were forced to sell your condo, well, you took a beating if you sold in 2008. But if you would have held it to now, you would have been fine. So, yeah, that's essentially what happened. And it started off as a whisper, because some people requested some withdrawals. Then they went around back to the venture capitalists, and they were asking for $2 billion in liquidity. And that request for $2 billion in liquidity scared the hell out of all the venture capitalists. And that's when they started telling all their clients, like, hey, you need to get your money out. These guys are having money problems. So what could have been like a bleep in the sort of scheme of things turned into a panic as everybody tried to withdraw their money at the same time. Now, that is part of the story, not the whole thing, because it gets a little bit more interesting if you're interested at all in this sort of thing. It's interesting to me. So now, here's where it gets interesting. And I'm not interested in a political discussion at all, okay? But there was something in place that was supposed, because this is actually, and the point of this video is not to convince you that what's going to happen in 2008 is going to happen again. I do not believe that it will, okay? But at the same time, it's sort of the same thing. You know, back in 2008, the banks went under because they made a bad investment, but it had nothing to do with the run on the banks. They just made really, really terrible investments because they were buying mortgages filled with lies that just were never real to begin with, and they were lending money to people that the bond was just garbage. It was worthless. You know, it was absolute garbage bonds that were that these investors were investing in. So as people defaulted, what they owned was worthless. In this case, the only reason it's similar is because it's still them taking your deposits and investing it into something that's supposed to be long-term and stable. Back then, what they were investing in was absolute garbage. In this case, what they were investing in was actually not terrible. It was actually pretty solid. The only reason that they lost money is because they were forced to sell. Okay? They were forced to sell. But if they didn't have to sell, they would have collected 2% on $117 billion. Again, that's a couple $1 billion a year. That's not terrible. Okay? So, now, regulations. Because, and this is a completely separate article. It is a completely separate article, something from November, in which the government was talking to banks to see if they should ease the guidelines, ease the regulation to make it easier for big banks to buy these same treasury bonds that caused this upheaval of SVP, okay, or SVB, excuse me. So let's take a look at that. Oof, we're getting a little long here, but it's okay. Okay, so where is this thing? 2000. This is the stress test. Okay, whatever. We'll skip the original. The Dodd-Frank Act was put into place after the 2008 collapse, and there were guidelines specifically for this sort of situation, because at the end of the day, any sort of trading, be it stock, bonds, crypto, options, futures, forex, any sort of trading carries risk of loss. Okay, the guidelines that were put into place after, or the regulations, not guidelines, the regulations that were put into place was supposed to avoid this sort of collapse. And it's bankers didn't like it. They felt like they were being babysat, but the recession was a real deal, and it destroyed a lot of people's lives, including mine. So those regulations were put into place in order to protect the public. So in 2019, some of the regulations were lifted in order to make it easier for regional banks to grow. One of those regulations was how much of that excess cash you can have invested in treasuries, in long-term treasuries. So how much cash can you have invested in long-term treasuries versus how much cash you just keep in the bank, So, and I don't know exactly what the percentages were, but there was let's say for every 100,000 you have to have 20,000 in cash, something along those lines. Those guidelines were lifted in 2019, okay, and that is what led to this bank being able to take this amount of risk, okay, because yes, it was the venture capitalists that created the panic, but they should have been positioned a little bit better, so even a run on the bank of this sort doesn't lead to a complete collapse within 44 hours. I think that part of the problem was that they grew so quickly. They grew so quickly, and by so much. They grew so quickly and by so much that it was just difficult. They didn't have the processes in place in order to be able to deploy that capital in an intelligent and low risk way. And I feel like they were sort of stretching. They might have been. I don't know. I'm not a banker. But I mean, how does this happen? You had 117 billion. I think they had all of their eggs in one basket, or too many of their eggs in a single basket. And I think that's one of the main reasons why the collapse even happened. Okay, so this bank was $200 billion. In 2019, they were a lot smaller than that. And the big banks, one thing that I want you to know, the big banks you don't really have to worry about so much, because the big banks still have the stricter regulations. The regulations were lifted on smaller banks. The limit of how much, it was like 10 billion in assets. If you had over $10 billion in assets, you had to do a lot more paperwork, and there was more regulations and more government people all in your business. And one party doesn't like that, so they were like, no more regulations. And there's good in lifting regulations because Wall Street likes it, but there's also risk because sometimes people make irresponsible decisions. And I think that this was a combination of irresponsible decisions along with the venture capitalists creating a panic. Also, there's something called a stress test. So a stress test is government officials and their mathematicians go in there and they run through various scenarios. So what happens if interest rates goes up? What happens if interest rates go down? What happens if inflation goes up? What happens if inflation goes down? So they take their mathematicians, they run their numbers in all of these various scenarios to see how well positioned an institution is to get through that sort of thing. And based on that stress test, as it's called, they set tailored regulations for that bank depending on what their risk factors are. So a stress test would have likely caught something like this, but again, The regulations were lifted from banks over $10 billion to banks over $250 billion. So it's only like 10, only a handful, well, 15, maybe 10 to 15 banks have to go through all those regulations, when before it was a lot more than that. But, they wanted to make it easier for banks to make their own decisions, and this is part of the result. As you can see here, Charles Schwab goes down 19% about banks sitting on big bond losses following the Silicon Valley Bank collapse. Now, reality is that, yes, these banks are sitting on heavy unrealized gains, but they're still making money because there is no foreclosure tidal wave coming, because the people who bought houses this time around are very well qualified because of the Dodd-Frank Act. There is no more. There's still mortgage fraud, but it's nowhere near as severe. It's nowhere near as severe as it was. Now the most common type of mortgage fraud is occupancy fraud. So essentially, you say it's your second home and then you start renting it out immediately. You say you're going to move in, but it's your second home. That's the most common type of mortgage fraud right now, and it's actually, Florida is the worst state for that, by the way. And there were people that saw it coming, because it's really not, if you know what you're looking for, it's not that hard to see. So for example, you could go out and there's like 6,000 or 7,000 banks in the country. You could look for other banks that have a similar type of exposure, that they have maybe a little bit too much money of their money in treasuries. And if you think interest rates are going to go up, then that means that they're going to be at a loss, and you can bet on that stock going down. So there were a few short sellers, not necessarily with SVB, but just with regional banks as a whole. They saw that there were some issues there, and they've made billions of dollars off of the bank stocks going down, because they haven't collapsed, but they've dipped. We can say that. So I feel like this video is way too long. I don't know if I made any sense, but that's gonna be the cut. And it was off the top of the head. Hopefully you learned something. I don't think that there is really anything to worry about. It's not worse than it was last week. Everything is generally fine. The government stepped in, because the one thing that could just blow us up is if everybody panics and everybody rushes to try and take the money out of the bank at the same time, and forces banks to cash in to make those unrealized gains instead of collecting 2% over the long term. If they have to sell those bonds at a loss, then it could lead to more regional banks going under. As far as the big banks of the world, you don't really have to worry, because they're under the more rigorous guidelines or regulations that Dodd-Frank set up. And I feel if we just stick to the regulations that were under Dodd-Frank, these sorts of things would be very difficult, because there's a lot of care and thought, and it's just a more conservative way to run a bank. But at the same time, being more careful with how you run your bank might lead to less profits. So you sort of have to balance that. You have to balance making money, taking risk, all these things. But in general, this is not coming to a neighborhood near you. This might not be the last banks that go under, but it's really the regional banks are the ones that have the exposure. The big banks, I think, are generally fine. Is that 100%? No, because if there is some sort of panic and everybody does rush and get money out of the bank and put it, God knows where the hell they would put it, because you got to put it somewhere, then it could be more severe. But still, at the end of the day, I think we're going to be fine. Anyways, 30 minutes. There you go. If you have any questions, feel free to reach out. I'm more than happy to help.